I'm having issues on that part with the grade book with Cengage, so we're working on getting it. Oh, on your total points, can you see total points earned on that particular screen?
I think so. Yes, 120 out of 120.
Right. And how many of that was for the two things that we can see there?
It says only 10 points were up for that.
For the discussion board?
Mm-hmm.
So the other points were coming from what you've already completed,
Okay.
correct?
I'd have to assume so.
Should be. Okay, so for now, what I'm going to just have to tell everybody to do is your total points will show up in the Cengage gradebook part, and you'll just add the points, of course, from that one assignment that is not interrelated with Cengage, which was your discussion board. Does that make sense? But I think what's happening is it's adding the points into the My Grades section of Blackboard. It's just not detailing where those points came from. Does that make sense to everybody? So if you ever have any questions about your total points to date and you can't see it, Cengage is aware that this is an issue and they're working with me, and I say with me very lightly because I don't have any control over how this operates behind the scenes. They're working on it. Whether or not they can get it fixed by the end of the semester will be the question of the year. So you're just going to have to kind of keep up on that. Is everybody following me? You've got to keep up with your total points through Cengage or looking at that My Grade section of Blackboard, knowing that that is the total points. Should be accurate that you have earned to that particular day and time that you're looking at it on all assignments that you've completed. Okay? Does that make sense to everybody?
Also, in terms of exams, will we be taking them in the building, or will we be taking them on our own time before the deadline, after we've taken care of the necessary chapters?
Right. You will be taking everything on your time, at your location. Nothing will be done in class as far as any exam taking or anything. Is that clear to everybody?
Right. And on the week of an exam, what will we be doing in class?
Will either be, because your exams will be on a Tuesday evening, and so the Monday, if there's an exam for that week, and we're meeting on Monday, we'll talk about any questions that you have on that particular material, or be starting new material.
Right.
Does that make sense?
Yeah. We can only take them on the Tuesday, or we can take them before
No, you can take them anytime before the due date. Is everybody clear on that?
Right.
You do not have to wait. In fact, I would recommend that you never wait until the due date to take an exam.
Right. Yeah.
Because if you've got computer problems, internet problems, I just can't help you with that. So I highly recommend the entire course is open for you today. And so you could, if you got really ambitious and wanted to finish the course work in a couple of days, go for it. I don't recommend it, but you theoretically could if you wanted to. Does that make sense?
Right.
So do not wait until the last minute. Do not wait until the day of unless you absolutely have to. Because on homework, of course, you can take it as many times as you want. Quizzes, you can take it, I think they're unlimited as well. I think everything is unlimited except the exams. And the exams you can only take one time, I believe.
I think the quizzes and I think only the homework is unlimited.
Oh, really?
Yeah.
So quizzes were two times?
I think quizzes, last time I checked, were only one time.
I thought I had set them up for two, but I'll double check it. If I have not set them up for 2 attempts, I will make that. The whole purpose on giving you unlimited attempts on homework is to make sure that you're ready for the exam. Everybody understand that? So that you do have plenty of application and work time, so that when you get to the exam, knowing you only have one chance at the exam, you need to know your material before you start it, obviously. It's not one of those type of exams like history or government that, just because you've got a book in front of you does not mean that you'll have time to get the right answer. you know, history and government's a little bit different. I'm just using those two subjects as an example. If it's asking for a particular date and time, I mean, I'm not stupid. No one's naive in here to think that if you're taking a history or a government exam that you don't have access to something there in front of you. Accounting, you can have your book in front of you, you can have anything you want to in front of you when you're taking these exams on your own, but the chance of being able to find that particular application question is gonna be slim to none. Does that make sense? It's not looking up like, what date was America's independence? Okay, it's not a yes or no date question. It's an application of accounting. Okay, so does that clear up any questions anybody has on just the, first of all, the grade book is a very conflicting answer I have for you in that I don't really have an answer.
And those exams will be a hybrid of multiple choice and math?
Yes.
Okay.
Well, not math, application.
Oh, sorry.
Multiple choice, some will have some true false on it maybe, and some of it will be completing the work assignments. And we'll look at a homework so that I can make sure everybody is getting it when you get into the debit and credit part. That's where everybody has a tendency to get lost first. Okay? So I'm going to try to pull that up here toward the end of class. Okay, so if there's no other pressing questions, we'll move forward. It does take a little bit of getting used to in accounting, because it is not like any other course you will take as far as how you're going to answer the questions, etc. So let's just talk about briefly. I'm going to skip chapter 1 just because it was really just all reading about what accounting is, and I mean, we're going to talk about what accounting is, but just some of that stuff that hopefully you've read it and you got enough out of the reading of the material that you're okay. But let's go on to chapter 2 then, because that's where your homework's going to be, and that is where the complications begin. Accounting is nothing more than any business, I don't care how big or how small they are, they're tracking financial transactions. Does that make sense to everybody? Everything in a business can be considered a financial transaction. Oh, also, word of caution, unless you've been living in a hole, let's put it this way, there have been a ton of positive COVID cases on this campus already in the week or two that we've been here. So be super careful, everybody. You know, keep your hands washed. I'm not a mask wearer, but I would suggest that if you've got any kind of compromised immunities, you definitely need to be wearing one. And if you're sick, again, please do not come, okay? That's like, again, my paramount rule number 1. I'll get you caught up, we'll do videos, we'll do whatever we have to do to get you through it, but don't come here if you're not feeling well or think that you're not fixing to not feel well, etc. I was in a gas station yesterday, we were traveling, and so we stopped to get a drink and walked in, and just, I felt really sorry for her, but at the same time I was just like, oh my gosh, I gotta get out of here, because she was coughing up her lungs in the convenience store, no mask, no nothing, and it was really kind of freaking me out. Have you ever been in that situation? You're like, how fast can I get out of here? So if you're coughing, sneezing, etc., we're all going to stare at you. I'm sorry, but that's just, it doesn't really matter what you have, but that's what's going to happen, okay? So just, you know, don't get your feelings hurt.
Even smoker's cough?
Yeah, if you got smoker's cough, we're going to stare at you, so. We live in an old new world, so. Anyway, just please don't come if you suspect that you're getting sick, or if you've been around someone and you're susceptible to getting sick easily. Okay, so back to accounting. Our financial transactions can be, again, like we talked about, just the fuel, the cost of the fuel that you put in your car to get you here today. That would be, you know, even a minute financial transaction. It happened because you had to purchase the fuel to get here. Everybody agree with that? If you rode a bike here today, there may not be any cost that you can visually see, but someone paid for that bike along the way. And if it was, maybe even the bike was given to you, there was a financial transaction that went on, even though you didn't see it, in that gifts can be given to businesses that put things in place to help them make money. So when we talk about financial transactions, they don't necessarily have to be the exchange of dollars on that particular day. It is the incurrence of an event that created some kind of financial background to it. And so that is what in accounting we're trying to do. We want to know at all times, don't we, how much it costs us to run our business? The entire cost, not just the things that are easy to pick out, but there's always costs behind the scenes that we don't think about, like the cost of the building, the cost of the monitors, the cost of computers, the cost of chairs that you're sitting in, the desk that you're at, that they may have been purchased 50 years ago, we don't know, but they're still being used as part of the production of a business to produce some income, okay? And so that's what, in accounting, we're trying to do. We're trying to trace down to the smallest penny, if we can, how much it costs us to operate on a daily basis. And sometimes it's obvious, and sometimes it's not so obvious how much our costs are. But we've got to learn some accounting lingo, and that lingo, I had a student one time years ago tell me, I feel like I'm in a foreign language class, because they didn't have any business background whatsoever. And so pretty much everything I said was like foreign to them. And my suggestion to you is read, so that you can get on the same language page as me, okay? And I'll try to, and always ask questions if you don't understand something that I said, because it is a very unique language that we were talking about. First of all, a business entity. Probably the majority of you have never considered the fact that John and John Doe's tractor business over here are two separate entities, even though John is the same person, okay? John is an individual, or Jane is an individual, and if they have a business of their own, their personal life should be kept completely separate from their business life.
Even if you're a sole proprietor,
Yes.
and you're borrowing at the bank and they're filling out a balance sheet, and they want to know all your personal finances,
Right.
IRAs, everything, and that's on that balance sheet.
Right.
And then you borrow against that, a lot of it.
Right, and that's not exactly what I'm referring to, because yes, banks are a completely different entity and breed of their own, in that a lot of banks won't loan you a nickel unless you've got a nickel. Anybody had that experience?
It's money to make.
Yeah, it always takes money to make money. And so the bank is going to look at John personally and John's tractor company as two different entities, but yet the bank is going to pull them together to decide if they're going to loan him any money. But that's not what we're doing in this class. We're looking at it from the point that we're getting some records in place for John to be able to take to the bank. And John's personal stuff is John's personal stuff, and he needs to deal with that on his own, so to speak. As the accountant, we're worried about John's tractor business over here, and how are we going to take care of the books to make sure that John knows if his tractor business all on its own is making money or losing money, okay? So that is our goal as an accountant, is to track the financial transactions in the entity for which we are reporting, and here the entity being a business, okay? And so that talks about the business entity concept first thing in chapter 2. Business entity meaning the separation of John and John's business, or the separation of a corporation and its shareholders. Because theoretically, if you own one share in Walmart or one share in ExxonMobil Corporation, you are an owner in that business, whether you realize it or not. However, as far as an entity is concerned, Walmart or Exxon or any publicly traded company would never consider our assets personally as a shareholder when they're doing any of their business transactions. Does that make sense? It's just completely separate legal entities. So in chapter 1, it did talk to you about, we've got sole proprietors, we've got partnerships, corporations, and of course there's a lot of other variations of those entities now in legal terms that we're not going to get into necessarily in this class. We are concentrating on the sole proprietor. And so we've got John and John or Jane's separate business over here. And they should keep them separate, because the expenses that John or Jane have to spend on a day-to-day basis for personal living expenses like rent, or a mortgage payment, or a car payment, or groceries, or childcare. All of those things have nothing to do with, for instance, John's tractor business over here, okay? He may have to have them to get to work, but the IRS says, nope, that's not a cost of doing business. I had a client one year that, he was a physician, and he liked really fancy watches, and so he had spent like, I mean, it's a god-awful sum of money on this Rolex watch, I wanna say like $20,000. And, he wanted to write it off, because he said, I have to have a watch to know where I'm supposed to be at all times. What do you think the IRS, because he got audited, what do you think the IRS's response was to John's claim that he had to have that watch to know where he's going?
You need a functional watch, you don't have to have a luxury.
Right?
I agree.
So, what about just a functional watch? What if he had spent $20 on a Timex watch? What do you think the IRS would have said? Would they have allowed him to write that off? No, because that is a personal piece of attire, regardless of the function that it served. At that point in time, watches were never allowed, and the IRS specifically stated that, and I told him that. This is not gonna fly, this is not gonna work, and he didn't force me to do it, but I made him sign a statement that I warned him that I knew this was not going to work, and sure enough, it didn't, but that was his problem, not mine at that point. But the IRS specifically says anything personal attire that you would wear on a day-to-day basis to pretty much go anywhere, that is not a business expense, because I have farmers every year and all kinds of different professions that they bring me in receipt after receipt after receipt for their personal attire, because these are work clothes. And I have to every time tell them, the IRS says that if you could walk into McDonald's in that uniform or whatever you want to call it, not uniform, but your work clothes, and not be identifiable as, say, a bus driver, so to speak, then that's not a valid work expense. That's not a direct business
Going to
expense.
Depot and buying your year's supply of gloves for work.
The gloves
maybe
are whole-
heat with it, and coveralls.
Gloves are a different expense,
Okay,
because if they're required in the profession for protection,
yeah,
coveralls, probably not.
okay.
So, it's weird what works and what doesn't. But the whole point here is that we're trying to separate on an entity basis what John or Jane have to have personally and what John or Jane are expending as a direct business expense. That's what we mean by an entity. Cannot separate these two. And we should separate those two. So, let's talk about assets then. What is it that we're trying to keep track of? And the number one thing that we're trying to keep track of are assets. So let me give you just a quick little illustration, not illustration, but, and this is where I'm going to switch you to a document camera. So I will lose your face, Annabelle, but holler if you have questions. Well, I thought I was going to lose you there. Okay. So we have three elements, primary elements in any business that we as accountants are responsible to keep track of. And the first one are assets. And if you've never heard that expression or you haven't really read a formal definition, hopefully you have seen that so far in your reading, that an asset has three criteria. And again, this is my lecture. This is not the lecture, this is not verbatim from your book. And so you may have other things that you think of because of what you're reading. I am here to amplify it, not to replicate it, okay? So your asset, first of all, is something that you own. Does the business own it? So if the business owns and operates out of an office building, that is the title and the deed is in the business name, that is an asset of the business. But what if they rent that building from, Jane Doe down the street?
That would be a liability.
Kind of.
Businesses.
Right, the rent will eventually become a business expense, but because we, the business, do not own that building, it is not on our records as an asset. Does that make sense? Because we do not have ownership. So we only keep track of or portray assets on our financial statements that we own, that has monetary value. Does it have any dollar value to it? And I don't mean necessarily today, but at some point in time, did we have to expend dollars, or did it come into our hands with a value of dollars appropriated to it? In other words, a piece of used copy paper that is laying in my office is not an asset. There is just no monetary value to that. Even though I own it, and it's sitting there on my desk, and the information on it may be appropriate for the business, it is still not of value, okay? And the key thing, what I just said, if you didn't catch it, it has to have some future economic benefit. That piece of used copy paper has no more future economic benefit. So the assets that we typically think of are buildings, automobiles, tractors, equipment, computers, desks, chairs, etc. We own them if they're in our possession. They have monetary value from the day that we purchased them or that they were contributed to our business. And the future economic benefit is what? What do assets do for us that give them value that we want to make sure and keep track of them? Let me just think about it. If you're Jane Doe, the taxi driver, what value does Jane have in her actual taxi, the automobile that she possesses?
Being able to complete jobs?
Yes, she's completing jobs. She's able to take that vehicle and on a daily basis go and produce more assets. And what asset would that be that she's producing?
Money.
Money. So therefore, money is a very significant asset. And I'm not saying that it's significant in that it's huge, because some businesses may have small amounts in the bank, some may have huge, but how long can you go without some kind of money in the bank?
Not very long.
That's right. There's an old saying, money isn't everything until you don't have any, you need some, or you don't have enough. Then it does become almost everything, doesn't it? So it's just a sad fact of life that Jane has to have money to put fuel in her taxi. Jane has to have money to pay the insurance on the taxi. Jane has to have money to buy new tires, to maintain her taxi, to advertise. The things that you don't ever think about, it all costs money eventually. So again, assets are a huge deal that we keep track of, because that is really where our value is going to lie eventually, is in the fact that if Jane or John decide they want to sell their business, why would you buy someone's business?
Because it's making a lot of money.
Because they're making a lot of money. What else?
There's a potential to make money.
There's a potential. But if they're not doing it so far, chances are you might kind of, I don't know about that, right? But what if they've got a lot of assets that you can then turn around and, think that you can make some money off of? So most of the time, businesses are valued by one of two things, or the both of them combined, and it's usually the both of them combined. What is it that I'm buying physically from you? What do you have to offer me? Yeah, you could definitely put a value on that customer base, and that is an asset that we'll talk about later on in the course. But the big thing is also, what are you earning right now that I would want to have a piece of? Okay, because if you're a failing business, chances are someone's going to walk in and want to just buy your business for as little as possible, because they're going to have to put a lot of work in it to turn it around, right? So the only thing at that point that a business is really worth is, what is the fair value of your assets? because I'm not gonna pay you for a failing customer list possibly, because obviously your customers aren't doing business with you, so why do I want that list? Agreed? So assets are different for every business, what they are comprised of, whether it, again, be equipment or buildings, or if it's just simple things like money in the bank. Well, most people aren't gonna sell their money in the bank, but they are going to be selling that future economic benefit that came around with those particular assets. Okay, so that's element number one. Element number two are liabilities. Liabilities are just the opposite of things that we own. These are things that we owe. That's right. We owe someone something. Does it have to be strictly money? No. It could be the fact that you are Jane Doe, the house painter, and you took a 50% down payment from Ruth over here that wants her house painted, and you promised to come back at a future point in time and paint the house and provide all the materials for it. So what happens if Jane doesn't show back up to perform at Ruth's house? What's Ruth gonna do? Sue, probably. Ruth wants a refund, doesn't she? I want a refund of my money because you owe me, you, Jane, owe me a service. You either owe me the service that you promised or you owe me the money that I gave you up front. You either give it back or perform. So a liability is something that we owe, either dollars or service. Okay? So there is going to be, instead of a future economic benefit, there's a future outlay of assets. Either money to pay off the liability, because that's most of the time when we think of liability, we think of owing people money, and that typically is 95% of all liabilities is because we have borrowed money to purchase automobiles, tractors, equipment, or just supplies. And we're going to have cash to pay those off in the future. Okay? So we owe dollars or services. It is going to require the future outlay of assets. That is really as simple as the liability gets. When in your book, you're going to see the expression accounts payable, notes payable, or on account a lot. So you have to, this is where the language part comes in. Accounts payable means that I owe someone on an open type of an account where I was using that as, quote, like a line of credit. I went to Office Depot and at one time, let's say that Office Depot, let me change this around. Let's say John Deere Tractor Company. I went to John Deere and I wanted to buy a tractor. And they had some in-house financing. Everybody know what that means? Basically that John Deere, that particular John Deere business will loan me the money to buy the tractor. Okay? And so I have an account with John Deere now. I have an open accounts payable, meaning in the future I'm going to owe John Deere Tractor Company for whatever amount it was that they loaned me to buy that tractor. And so I purchased the tractor, what we call on account. I did not give them cash. I just literally signed my name to a piece of paper that says, you now have an account, and a liability account with John Deere, and we expect you to pay that. So that is an accounts payable. The expression payable means to be paid. Account to be paid. So that is a liability. A note payable would be a longer period of time, which is actually probably what a John Deere type situation would be. It is to be paid as well, but a note meaning that we have an extended period of time. We have signed a note promising to pay not only the amount that we borrowed, but probably a sum of interest with specific payment dates in between the time that I borrowed it and the time that I paid off. And the expression notes payable comes from the fact that, before computers, before technology, et cetera, people literally, signed a piece of paper that resembled what a note card would look like. I know that's hard for anyone to grasp, but that's exactly what it was. And they would have file after file after file of these little bitty note cards that everyone had signed promising to pay. And so that note indicated all the terms of the agreement. What am I going to promise to pay you in exchange for walking out the door with a $100,000 tractor? Okay? So that note payable is extremely, is very much a liability over an extended period of time. What's a mortgage payable? Anybody own a home with a mortgage?
You may make down payment and you have some equity into it from paying on it over the years. You're still considered to be the owner, but the mortgage company still holds the title until it's paid off.
That's right. So a mortgage payable is, again, to be paid, but a mortgage is even over a longer period of time than a note. It's usually over 15 to 30 years. You hear of a 15-year mortgage or a 30-year mortgage. We're going to give you a longer extended period of time to pay, because usually a home, that a mortgage indicates this is a loan against a house, a personal residence usually, that we're going to give you an extended period of time to pay it because we know it costs a lot of money up front. And no one could usually walk in and pay cash or say, oh, okay, I'll have this paid off in 5 years. It would just be near impossible. But all of these, especially a note payable or a mortgage payable, there are liens against the property. In other words, it's a legal term to basically say, you may have possession of that house, you may have possession of that tractor, but we, the lender in that transaction, we have ownership as well, because you haven't paid me everything. So if you miss a house payment, what's going to happen to you? Or let's say you miss 6.
Taking the house back.
Taking the house back. Because who owns it?
Wonder.
The lender. They own it first. And we'll see that in just a second. Okay, so these are two real big components that, as a business, we definitely want to keep track of everything that we own and everything that we owe. That's just kind of right there. Does that not kind of tell you the value of a business? What they own and what they owe? That's how you're going to start evaluating, okay, if I'm trying to buy a business, do I want to buy yours? Well, I don't know. Let me see what you own and let me see what you owe. Because you're not going to be able to buy those assets that have been encumbered with a loan outright. You're going to take over the loan if it's not paid off before that. Okay, so now let's talk about then the difference between them. So we have assets and we have liabilities.
Then we have owner's equity.
We sure do. These are the 3 components of any business, and what we call the 3 elements of accounting. We already said that assets are what we own, right? We said that, liabilities are what we owe. And in accounting, we will set up our system of keeping track with these 3 elements as being the foundation of our accounting system. And as we talked about, I think we briefly mentioned this on the very first day of class, this particular formula, this particular foundation and process has been around for thousands of years. And in every single business entity in America today, no matter how small or how large, this particular formula that we're going to present here is fundamental and inherent in every single business. You can't find one that it's not. And that their system was not developed with this in mind, or this is the foundation. because we have the fundamental accounting equation, which is basically assets are equal to liabilities plus owner's equity. So let's talk about owner's equity. First of all, I've already said assets are what we own, liabilities are what we owe. So what does the word, if you've ever thought about it, does anyone know what the word equity means? And I'm not talking about the accounting word equity, but if you're talking about equity in just a layman's term in the dictionary, if you were to look it up, it means ownership. That's the only thing equity means, is ownership. So here's John or Jane's ownership in their business. Is it not the fact that everything that they own minus everything that they owe, that's what they own? Because we just talked about, if you don't make the payments on your house, the mortgage company's going to come and take your house. Why? Because they have
a promissory note that you will do this in this certain term, under these certain terms, in this certain time period.
Yep, they've got an agreement from you, and what they have essentially done is they have documented ownership in that, haven't they? And so that you may own some of it, but we own a lot of it, okay? So ownership has to do with the owner's ownership. Owner's equity means the owner's ownership. It sounds redundant, and it is slightly, but it really is what it's referring to is that outright, this is what the owner owns of the asset. But creditors have ownership as well. Creditors' ownership is actually called liability. It's the creditor's ownership. So assets are owned by one of two people. They're owned by the owners of the business, or they're owned by a creditor. Everybody agree with that? There's nobody else out there that owns any of these assets. Yes?
Assets is basically the net ownership or overall ownership.
Not the assets, the owner's equity is what you're referring to. Net assets equals owner's equity. And there is different words that your book uses. Owner's equity can be net ownership of the assets or net assets. The leftovers, I like that one. Because if I do this, if I say assets minus liabilities, doesn't that work? If this is my fundamental equation, right here, then can't I subtract one of these from assets to get the other?
As long as you know till you can get the other.
Yep. And it's a simple, first or second grade equation? I can't remember where equations actually begin in grade school, but it's really early on because they're very simple. And this is literally the simplest equation that you can come up with. And this is the most difficult math you'll do in accounting, is subtraction. Okay? Because at any point in time, if John or Jane want to sell their business, they're going to present to you, a potential buyer, this is everything that I own. These are all my vehicles. This is all of my buildings, possibly, that I'm operating out of. These are just all the assets that I have, computers, equipment, et cetera, et cetera, et cetera.
And I hope I'm not getting off subject exactly. I think for me, where I'm starting to, I have real life experience with some of this stuff, but yet I'm struggling with this chapter 2.
Yeah.
Things we're supposed to. You may buy a piece of equipment, so it will become an asset, which is a plus, and you add it to as your liability, but it's actually a deficit because you owe something on it. Yet it's still going to be represented in terms of a positive figure of assets, but you have a negative liability.
Yeah.
And I'm mind screwing myself.
Way overthinking everything. I want you to literally think on a first grade level, okay? That's the only way you're going to get through this particular piece. Because in accounting, nothing's ever a positive and nothing's ever a negative. Okay? Promise. So, let's move forward, and I'll pick up the speed just a little bit so I don't get you, in the mire, so to speak, get you boggled down into there. But let's look at a real simple home equity situation, a home ownership situation. Let's say that there's a $100,000 house out here that we like, or that John likes, and John's gonna buy it, but John's only got $1,000 in his pocket. What is he gonna have to do to buy that house?
$1,000 down.
He's gonna have to go and find $99,000 more dollars, isn't he? And where's he gonna find that? More than likely,
Alone.
a loan. He's gonna go to the bank, he's gonna go to a mortgage company, he's gonna go to somewhere that lends money, okay? Y'all look like you're in Alaska. Do you feel like that? Okay, I'll turn it up. So, the asset is the house, right? And we can't say that it's worth only $1,000 just because that's all John has. John needs to record the fact, that let me put this in the, side of a business. Let's say it was an office building. John wants to buy this office building. And so, the office building is, valued, I'm gonna go back to my fundamental equation here. Assets equal liabilities plus owner's equity. This equation is in place at all times for any business. Okay? So he's got a $100,000 office building that he just purchased. And, he had $1,000 down, and he's already given him that, but he had to go to the bank and borrow a $99,000 loan, or put in place a $99,000 loan. So right now, he owes $99,000, doesn't he? So if this is a simple first grade equation, if I've got $100,000 on the left side of the equation, and I've got $99,000 on the right side of the equation, what do I need to balance this equation? I need $1,000 more on the
Owner's equity.
right side, right? Here's the left, and here's the right. So if he simply adds $1,000 over here to the left side and calls it his owner's equity, he has an imbalanced fundamental accounting equation. Because in theory, there is an office building out here that we're tracking, a $100,000 office building. But $99,000 of it belongs to the mortgage company, the creditor's equity. Only $1,000 is John's owner's equity. John owns $1,000, the bank owns $99,000. If John decides to sell that house tomorrow, and if he sells it for $100,000, what is the bank gonna get? $99,000. John will get $1,000. That's proof of ownership right there, isn't it? What are you gonna walk away if I sell it? You're gonna walk away with. So I like to call owner's equity basically the leftovers. Leftovers of what? Assets minus liabilities. That's what the owner's equity is. They get the leftovers of everything that they own minus everything that they owe, because it doesn't have to necessarily be specifically tied to the house. He could just owe $99,000 in debt for all kinds of other things, and maybe he just has $100,000 in general assets like equipment, tools, the list could go on and on. But if at any point in time he owes anyone $99,000 and he can only account for $100,000 in assets, he or she only owns $1,000 in equity or ownership of those assets. But that doesn't mean we need to keep track of all of it, okay? So accounting is just a procedure. It's not necessarily a theory. There's some theories that we apply to it, but it's not anything but a very concrete procedure that we're going to use to track everything that comes into our business that has monetary value and everything that leaves our business. Okay? And if you can get to the point that you actually totally understand that all we're doing is keeping track of this equation, this first grade equation, then you'll do much better than if you try to analyze. And again, in accounting, we don't use the phrases positive, negative, plus, minus. We use how many assets do we totally own, how much do we owe, and then we know the leftovers are, quote, ours.
On that first homework though, when we're when they're filling out the table,
Uh-huh.
in parentheses, you would, and then where I see on balance sheets or something, you would have a negative figure, but it would be in parentheses to reflect. I know we don't supposed to deal, I don't know, I'm probably gonna sit down with you, cause
Yeah, it's, I mean, you could, I don't wanna get into that part because
Okay.
it's too complicated on that, but, if we rearrange our equation, then yes, our liabilities are, quote, gonna be subtracted from an asset, so we have that negative sign in front of it. Is that what you're referring to?
I'll just be quiet.
I'll caution you this, chapter 2 can be very, confusing if you're gonna use that to be your, push forward to understand the rest of it, because it's really what it's trying to illustrate you is the actual theory behind why we're doing what we're doing. But eventually, it's going to be a process that we're gonna learn, increasing this, decreasing that, et cetera. Does that make sense?
I think you're just overthinking all of it. That's because isn't that where the debit and credit comes in?
Yes.
Yeah, that's why you would never have a negative. 'Cause
Right.
You would always be adding one or the other and you never subtract.
And chapter 2, because that terminology has not been introduced yet, the debit and credit, then you almost do, I guess, kind of have to have a negative in front of something to make the equation balance. Because again, when you've got an equation, there's going to be certain things that happen to keep it in balance. It truly is a balancing act. Okay? So, the number one issue I would say for anyone struggling at this point is that you are overthinking it. Totally. Okay?
But when
So-
those notes come due, I wanna know how much I owe.
Well, that's,
And that figure, and as I would progress through the season, I wanna know, cut back on input, so I don't have to go back and give more money, and I'm getting into a different complicated stuff, sort of, that we're gonna talk about maybe even all of the semester, but that's the way I think about it.
yeah, and,
Cause I've been there.
Yeah, there's lots of people that think different ways, some people are very, very, very business-minded, and this clicks immediately. And some, will try to make a reason for everything that happens, and that was my husband in accounting. He wanted a reason for every single thing, and there is no reason. Sometimes business just happens because this is the way it's calculated. Does that make sense? I don't know how to, I'm a very, very, very black and white person. You give me a rule or a process, and I can memorize it, and I can go from there. Eventually, it will all start clicking, if that makes sense. Sometimes, you have information in front of you that doesn't necessarily make sense immediately until you've worked with it for a while. Does that make sense? But accounting is definitely one of those that you learn by doing. You don't learn by reading usually, and I'm going to take that back. You have to read this material. You have to. But it's going to be reinforced when you start doing it. Accounting is definitely one of those application academia subjects versus just reading it and memorizing it and knowing that it's going to be that always. It's not going to be. Because there's going to be a different little thing for everything that you do. But let's move on just a little bit so that we can get to what the full accounting equation, and I want to say that very lightly. And if this is the full accounting equation, assets equal liabilities plus owner's equity, every single business, they have these three elements. And this is called our balance sheet. Why do you think it's called the balance sheet? Because it's in balance. You should be able to at all times present to yourself or a user of the financial statement what I own, what I owe, and this is mine that's left over. And this truly is, more than anything, I call this a plug figure. What do you think I mean by a plug figure?
You plug in all of your components.
Yeah, I plug in what I know, and this is what's left. I know what I own, I know who I owe, and then the difference is mine. That's pretty simple, isn't it? I guarantee you, if you were to walk up to someone and ask them what they were, quote, worth, their net worth, they'd probably look at you and, oh, I don't know, I'm not sure. And they really probably couldn't answer the question outright. But if you ask them, what do you own? Most people can tell you what they own. I own a house, I own a car, I own a dog, I own a computer. You know, they can start listing off for you everything that they own. Would you agree with that? Because most of us are pretty in tune with our ownership strategies. And most of us know exactly who we owe too, don't we? How come? I want to get a
Letters?
Yeah. Somebody's told us, reminding us, aren't they? If you owe someone, they're gonna be reminding you on at least a monthly basis, correct? If you've ever had a credit card, you get a statement from them at least once a month, and they'll tell you how much you owe them. If you owe money on a car, you have a monthly mortgage, loan payment, or you get a monthly bill, stating to you that last month you owed me $5,000, this month you owe me $4,850, because you made a payment. So we can put our hands on what we own and what we owe. It's the third one, this owner's equity, that most people struggle with, and they don't really know where to grasp that number. They don't completely understand it, but it's your plug figure. There's not anything really that you can pull out and put your hands on it and say, this is what I'm worth, because it's comprised of all kinds of different things. And it's also, of course, taking into consideration that you owe some people some money. So net worth is more of a calculation, not something that you can pull out of thin air and say, this is what I'm worth. It's a calculation, okay? It is assets minus liabilities equals owner's equity. So can a company continue on if all they know is what they own and what they owe? How are they going to make money? When do they start making money?
Start providing services.
When they start providing services. And we're going to concentrate on service-oriented type businesses in this class versus product-oriented business like, I don't know, someone that's making a product from raw materials and then selling that product. We're selling a service. So we've got John Doe, the tractor service business. We've got Jane Doe driving taxis. We've got people like me doing tax returns. We've got attorneys. We've got counselors. We've got, you know, all kinds of people providing services. And that's what we concentrate on this class. So until Jane starts driving her taxi cab, Jane's cab is not going to earn her money sitting on the lot. Agreed?
It's gonna depreciate.
Yeah, and we're going to talk about that for a few chapters. Yeah.
Okay.
So we've got all of the assets in place to start a business. There's probably some debt involved. Almost all businesses have at least a small amount of debt. But this particular formula has to grow a little bit to account for the fact that Jane is going to start driving a taxi and start putting gas in the tank and paying some insurance and that type of thing. So owner's equity then expands itself a little bit in that her equity is going to go up because of what we call revenues. Okay? Why am I adding that to this side of the equation? What do you think? What are revenues going to do to Jane's equity in her business? Right, it's going to raise it, isn't it? So we call revenues an increase to owner's equity. So what I'm going to illustrate here is I'm going to expand this equation with the premise that you have read your chapter and you know that assets, liabilities, and owner's equity are all what we call the permanent accounts in any business. Permanent meaning they do not go away from year to year. If December 31st rolls around and Jane has $10,000 in the bank at midnight on December 31st, barring any kind of electronic transaction that happens to her account in the middle of the night, Jane's going to have $10,000 in the morning on January 1st. Right? Yeah. In other words, Unless something happens, what's available on December 31st is gonna be available on January 1st. In other words, the passage of time simply does not make the cash in her bank go away. The bank doesn't call her up on January 1st and say, hey, I'm sorry, but now it's 2022 and we're gonna take all of your cash away. That's just the way we operate. What's she gonna say? I'd say, you are absolutely out of your mind, with a few more expletives in between, you know? Because that's not the way it works, is it? If it's your money, it's your money, unless you've spent it in that, 1 minute little period of time between 11:59 p.m. on 12/31, it's gonna be your money at 12:01 a.m. on, January 1st. Everybody agree with that? The passage of time does not make your assets disappear, like cash. And if you've got a car on the lot, and on December 31st, that car is gonna be there, January 1st, unless someone steals it in the middle of the night, right? And that's what we mean by permanent accounts. They don't go away because a new year starts, a new financial year starts. Liabilities don't go away either, do they? If you owe someone at 11:59 p.m. on December 31st, you're gonna owe them at 12:01 a.m. on January 1st, agreed? Unfortunately, a new year doesn't wipe out all of your debts. That's the one we wish would happen, but it's not gonna happen either, is it? You can't get away with calling your bank, on January 1st or 2nd, saying, hey, we started 2022, let's just call it even on that loan I owed on my car, and we'll start fresh. What they can say to you, you're kind of crazy, aren't you? That's not the way it works. But how many times do you file a tax return on income that you earned? Let's say 2021 is winding down, you've been working now 9-10 months so far, I guess, almost 9. How many times are you gonna pay income tax on the income that you're earning right now in 2021? How many times are you gonna file a tax return for 2021? Once. And you're gonna do that in the spring, depending on when you file, it'll be anywhere from January to October of 2022, but you're only declaring the income on that tax return that you earned in 2021, one time, so far. We got all kinds of new tax stuff coming, but right now, we as Americans,
Let you defer it.
Yeah. Unless you're live in another country, the United States of America only makes you report income that you've earned one time as far as being taxed to the government, okay? That then is not permanent, is it? Your revenues are not permanent. Your revenues don't stay the same from year to year because you may have worked an entire year in 2020 and had a full year of income that you needed to report. In 2021, what if you've been unemployed for 6 months? Well, they're not gonna go back and say, well, really, in 2020, you made a lot more money, let's just pay tax on that again. Would that be fair? No. So we say that revenues and expenses, and another account that we'll talk about in a second, are temporary. So these three accounts, assets, liabilities, and equities, are permanent, meaning that just because the clock passes to a new year, they stay in place. If we had them on December 31st, we're gonna have them tomorrow. But revenues, expenses, and a new expression that maybe this is the first time some of you had ever seen it, the withdrawals or drawing account, are temporary. But they are one of these guys over here, temporary. I don't know if that's spelled right or not today, Monday. They are temporary owner's equity. In that, if Jane drives her cab every week, Jane's equity is going to increase every week, isn't it? The more she's going to be able to put in the bank, and that is hers, because she's not borrowing revenues, she's performing a service. Every time she has to stop and put fuel in the tank, though, she's extracting some of her equity to pay for those expenses. And then every time Jane needs to make a withdrawal or draw money out of her business account to pay for rent and utilities at her personal residence, those are what we call a drawing account. In other words, it's not a business expense, but it is a withdrawal of her equity. And so these three accounts are temporary in that every year, January 1st, we're gonna open up those accounts with zeros. And so anything that was in those accounts at the end of the year, will be dumped into their permanent equity account before we start the new year. Because we don't wanna pay tax on the same revenues year after year after year. We cannot deduct expenses more than one time. And most owners wanna keep track of their drawing on a year-to-year basis. Okay? So, again, it takes some time kind of getting used to how we express these, phenomenons in the business as far as bookkeeping, but, it's all about bringing in or sending out of our business and how we're gonna track it. Why do we track these three elements separately then? Why don't we just track assets equal liabilities plus equity? The number one reason is tax concerns. Because we live in a country that collects taxes on earned income, our equity, of course, goes up every time Jane earns more money, and those kinds of transactions are taxable. If she earns $100,000 this year driving a cab, or doing Uber, whatever it is, then that is reported as a taxable event that she must report on her tax return. But if Jane were to have, say, her dad passes away and leaves her $100,000 inheritance, and she contributes it to the business, is that taxable? Do y'all know? Most people don't know, but it is not taxable. That is considered what we call personal contribution of equity to the business. It's not earned. She didn't do anything to earn it. It was just simply a gift that she decided to put into her business. So when an owner contributes that initial amount of money into their business to get started, that is not a taxable event. Jane could have been saving for 10 years to do this business on her own, and she saved up maybe $10,000 over those 10 years. She would deposit that money into an asset or a cash account. Does she owe anybody for that money? No. So whose money is it? I'll put it down here. She puts $10,000 into a bank account. She did not borrow that money.
You use equity.
So it is all hers. We can track that $10,000 as being all to Jane. So Jane goes and buys a cab now for $25,000. We need to record a $25,000 cab now as an asset. And she borrowed the entire amount. She didn't have a nickel to her name that day she went to buy the car. Yep, I need to record a $25,000 liability. So now I've added $25,000 to the asset column, $25,000 to the liability column, and she really doesn't have any equity in that vehicle until she starts making some payments. Okay? So can you see I'm kind of doing a double entry thing here? I've got that equal sign, and every time I entered on the left, I had to do what? Enter on the right. And that's where this phrase, double entry accounting, comes from. But we're going to shift that into left equals right. We've got the left side of an equation, we've got the right side of an equation. Would this change if this weren't an accounting equation? Let's say it was just some simple math equation that you were assigned. Does left and right change? Nope, it never changes. It's an element of nature, isn't it? We all can distinguish left and right. You learn that in, I don't know, what, preschool? And it doesn't change in accounting, it's still left and right. In accounting, though, when it was developed, it was done in the Latin and Greek days of speaking, and the word for left was De Beers. That's Latin or Greek for left. And it has been shortened to DR because De Beers in the English translation is debit. But we abbreviate it DR. Debit is abbreviated with a DR. from the original Greek or Latin word de beers. Because there is no R in debit, is there? So if you've ever wondered that, why in the world do we abbreviate debit, DR? It's because of the original word was de beers. Credit, a little bit more obvious, it's crediers, and we abbreviate credit with CR. Here's a number one thing I can tell you, and Annabelle, I'm afraid I'm fixing to lose y'all, but in accounting, the word debit only means one thing. Take a wild guess. What does it mean?
A subtraction.
Nope. Left. That's the only thing it means. And credit means right. Okay? And if you try to associate debit and credit with anything other than left and right, you are messing with your mind. So whatever you've got to do to get that out of your head, that debit and credit mean something good or bad or positive or negative or plus or minus, you've got to do that to be able to get through this course. Yes?
I'm gonna be back at my workplace at 2.
Okay, feel free to leave. I'm sorry. Anytime you need to get up and leave, you're not gonna offend me, so.